Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, welcome to the week that was, the weekly podcast that sums up market movements and events from the past week along with their implications on asset markets. I'm Michelle Castelino, your host for this week's episode. On the global front, bond markets were in focus after US Treasury announced it would at least double its long-term buyback operations to a minimum of $4 billion per operation, up from $2 billion previously. This move came after 30-year Treasury yield briefly climbed above 5.3%, its highest level since 2007, against the backdrop of US government debt approaching $40 trillion. Put simply, the Treasury is buying back some of its existing bonds from the market to improve liquidity and smooth price volatility, particularly at the longer end of the curve where buyers can be scarce during periods of stress. Importantly, this is not quantitative easing. Unlike the Fed, which creates money to buy bonds and influence financial conditions, the Treasury's buyback program is aimed at improving market functioning rather than targeting a specific level for yields. Markets initially welcomed the move. Long-term Treasury yields fell by about 5 to 8 basis points. The US dollar weakened and gold prices moved higher. However, our house view remains that this is still relatively small compared to nearly $30 trillion of the US Treasury market, meaning the impact on yields is likely to be limited. As a result, we continue to expect the US 10-year yield to remain broadly range-bound between 4.5 to 4.75%. Looking ahead, the bigger question for markets is whether the buybacks eventually evolve into something closer to yield curve control or a return to Fed-led quantitative easing. If that were to happen, it would likely be negative for the US dollar and supportive for gold. For now, though, attention is turning to Kevin Warsh's Jackson Hole speech next week, which could offer important clues on the policy outlook. With recent data showing softer payroll growth, weaker retail sales, and easing inflation pressures, a September Fed rate hike still appears unlikely. Turning to India, the macro picture remained broadly constructive despite a few mixed signals. Starting with activity data, the index of core industries rose 5.4% year-on-year in July 2026, moderating from a revised 6% growth in June, with iron ore output surging 29.5% and cement production up 13.1%, although fertilizers and crude oil production contracted. Meanwhile, labor market improved with the unemployment rate falling to 5.1% in July from 5.5% in June, marking a 4-month low and reflecting stronger rural employment conditions. On the external front, India's trade deficit widened to $31.98 billion in July, compared with $30.4 billion a year earlier, while outward FDI increased 17% year-on-year to $5.7 billion, highlighting continued overseas investments by Indian companies. The August RBI MPC minutes struck a relatively hawkish tone, with policymakers highlighting risks from food, fuel, and input costs and indicating that more clarity on inflation trajectory is needed before any policy recalibration. On a more positive note, India's external buffer strengthened further, with forex reserves rising to $716.9 billion as of August 14th, up from $707 billion a week earlier, signaling a strong improvement in reserves. Indian equities had another weak week, marking their second consecutive weekly decline, with Nifty falling around 0.5% and the Sensex down about 0.6%. Sentiment was weighed down by rising crude oil prices and escalating Iran-US tensions after Washington ruled out an extension of temporary ceasefire and Tehran signaled a more offensive stance. That reignited concerns around inflation and the interest rate outlook. While the US Treasury buyback announcement provided a brief boost to sentiment, it wasn't enough to sustain the rebound. Within the broader market, performance was mixed, with mid-cap index ending largely flat, while small caps outperformed, gaining about 1.2%. Looking across sectors, IT was the biggest laggard, falling roughly 2.6% after a major global investment bank warned of potential earning bubble risks in AI-related valuations. Other defensives and cyclicals also struggled, with FMCG down about 2.3%, telecom down 2%, and capital goods lower by 1.1% amid the broader risk-off environment. On the positive side, metals gained about 0.6%, supported by higher global prices for steel, copper, aluminum, and zinc, which improved profitability expectations. Realty rose 1.8%, while banks added around 0.5%, providing some support despite the cautious market backdrop. In fixed income and currency markets, the 10-year India government bond yield rose about 9 bips over the week to 6.85%, driven by RBI's hawkish MPC minutes, the advanced deadline for FCNR-B swap window, and the renewed inflation concerns linked to higher oil prices. Globally, the US 10-year yield increased by a more modest 4 bips to 4.73%, with the Treasury's buyback plan helping to limit a sharper rise in yields. Finally, on gold, INR gold jumped about 5.3% for the week, taking its year-to-date gains to about 20% as a weaker dollar and safe haven demand continue to drive flows. That's all for this week's edition of The Week That Was. If you found this update useful, don't forget to like, share, and subscribe. Thanks for tuning in and have a great week ahead.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.